Good afternoon. This is Chris Robinson, Robinson Ag Marketing, with today's postcodes grain and livestock comments for Friday the 12th. We're halfway through December. Um, there's a lot to cover, so I'm just going to try and hit the highlights. I will give the dailies and the weeklies. Um, I'm looking at crude oil right now as I was wrapping up with the outside markets. That is a 7-week low in crude oil at 57.44. If we take out 55, it's going to be a 5-year low. So there's something going on there. I mean, there's no big demand for crude oil. That kind of weighs heavily on the rest of the commodity market because it's kind of a bellwether. People see crude oil move and they want to get after it. Um, in the stock market, right? We could not get the 50,000 print. We tried really, really hard. We hit 48,917. So we got to within about 45 points of the 49,000 print. In the S&P 500, we could not hit the 7,000 print. We got to 69.15. We're still, at or near all-time highs. I mean, right now as I'm talking to you, the Dow is down 200 points on the futures. The S&P is down 70 points. It just feels like weekend position moving. If you look at NASDAQ, yeah, we're down quite a bit, 400 points, but that's all relative. Everybody had been looking to see if NASDAQ could get back above 26,000. The all-time high in NASDAQ was 26,399. We're at 25,002 right now. Got to remember though, just about 8 days ago, no, actually, I call it 2 weeks. 2 weeks ago, the NASDAQ hit 24,000. So to get upset about 400 or 500 point moves in the NASDAQ, it's like getting upset about quarter cent moves in the grains. Everything's relative. We're still near or at or near all-time high. So if you are positively concerned that 2026 is going to be, some disastrous year, you want to start, you know, taking profits and defending stuff now. You don't want to wait till after we have a 10 or 15 or 20% break. Historically, we always have a lot of corrections. Historically, 5% or less is just noise. 10% is a correction, 20% is a bear market. Um, every 5 or 10 years, we get a big correction, like a 55% whammy. And nobody knows exactly when those come. But I always tell people, if you need to lay hands on your money in the next 5 years, it probably shouldn't be in the stock market. If you can hold on for 5 or 6 or 7 years, generally that's a long enough time for you at least to get back to even. But that's just a general rule of thumb that you can look it up yourself. But the worst bear markets we've had, it's taken about 5 or 6 years to get back to even. The one exception I could note would be the Nasdaq. Back in 99, 2000, we hit close to 5,000. It took, I think, 16 years to get back to 5,000. So, there's always an exception to the rule with the broader market, which is what the S&P 500 is. Generally, it's 5 to 6 years to get back to even. And you don't have to take my word for it. There's a ton of studies out there which will show you the same thing. Just go educate yourself. So, all right, on that note, what's going on in the grains? Well, we slipped lower here today. Dees corn went off the board finally. Adios, Dees corn. We never got our 450 print, those sons of guns. Today's high was 37, 437. We settled at 431 and a half. So there's that. No more Dees corn. March corn, we talked about it. If you read my letter, if you're not getting my letter, take a look at it. RobinsonAgMarketing.com. Sign up for it. You can go month to month. I send it out every day, 6 days a week. On the weekends, I do, so it's 5 days a week, Monday through Friday. On the weekends, I do a big weekly wrap where I go through weekly changes and money flow and try and give you a 30,000 foot picture to try and keep your perspective, especially if you're a farmer producer. Because let's face it, if you're a farmer producer, you don't want to be a day trader. You don't want to be sitting in front of the screen all day. You want to be looking for opportunities to, when markets get, where they make sense for you financially, you try and do something to defend those rallies. But as far as, looking at it every single day and trying to catch every penny or every nickel or dime move, most people, I think, don't want to be doing that. So I try and keep a longer term perspective on my program, and that's why some guys, they'll read the weeklies, they'll kind of cruise through them, but the weekly wraps are the ones that I really spend a lot of time on. I do all my homework and try to explain to you what I'm looking at. Hopefully, it helps. So take a look at that if you're interested. March corn finished down 5 3/4 cent at 5.40 3/4. I've talked probably too much about the 200-day moving average, how we can't get above that. It doesn't make sense to me. We've had excellent exports, really good, powerful exports, and the market shrugs it off. Same thing with wheat. We're having great wheat exports, but we're about 25 cents from contract lows and 5-year lows. So sometimes people can get caught up in oh, this is great. We're getting all these exports. You want to be long, and the market doesn't agree with you. So don't let your personal bias hurt you when it comes to marketing. That's a hard thing to do. I know most people want to get emotional about it. That's one thing I try and help people not do. I always say the one thing: the price. It's like looking at someone's EKG for their heart. You may think you feel fine, you may think you're feeling fine, but inside, if your heart is skipping a beat, or if it's going 100 miles an hour, you don't feel any different. It's you still have an issue there. So that's what I look at the charts. The charts say it all. At the end of the day, it's the one thing, bull or bear, that we all have to agree on. That's why it's so important. So March corn finished down again at 4.40 3/4 at 5, down 5 3/4 cent at 4.40 3/4. March beans just 16 cents lower on the day, finished on their lows 10.86. Jam beans finished on their lows as well, with a 20-cent trading range. We traded as high as 10.94 and as low as 10.75 3/4. We finished at 10.76 3/4, down 16 3/4. Yeah, the Chinese have been buying beans. They're buying the dip. Mr. Market, it's one of those things: buy the rumor, sell the fact. We've just given back almost 60% of the $1.57 rally we've had. There's a gap down there that we're looking at now, which is around 10.62 1/4. We're trading 10.76. Why do those gaps matter? They just do, kids. And if you ignore them, you ignore them at your own peril. So there's a perfect example how every day it's like, oh, China bought beans, and we're going lower. The price is going lower. Um, you have to deal with the reality of price, not with what you wish it was doing or what you think it should be doing or anything else. So that's where we're sitting with the beans. We'll see what happens next Monday, but certainly we have dropped 92 cents from the high of the move in jam beans. We traded as high as 11.69 and a half. Today's low, if you take from the tippy top to the bottom, 92 and a half cents after getting a nice $1.57 rally. And that's why marketing's so high. Nobody gets a text message saying this is the high. Nobody gets a secret email saying, oh, this is the high. We have to take advantage of the markets when they give us these prices. That's all we can do. And we'll look and see, is this a dip to buy? I don't know. If you sold up there, you may want to start looking at re-owning those bushels. If you have to sell right here, if you're being forced to sell right here because you need cash flow and you're like, son of a gun, I just lost $1 because I didn't sell it higher, or I lost 90 cents. I get it. If you're selling here, you're still selling at 10.76. That's still better, the last time I checked, than the October low at 10.12. You're still 60 cents to the better. So yeah, I would say, and if you're concerned that as soon as you sell it, the market's going to change, they're going to be back up to 11.60. When you make the sale, you re-own it with a call option. And that way you don't have to be right. You're just making a business decision. Try and make a business decision as opposed to making emotional decisions. I think that's something that everybody out there can do more of, myself included. November new crop beans finished down a dime at 10.88 1/4. Same idea there. We had rallied up to 11.31, I believe, was the high on the move. We'd have about an 83-cent rally, and here we are, at 10.88 1/4. There's a gap on the charts that everybody's looking at there. Where does that gap come into place? Right around 10.82 and a half. So what's going to happen if and when we hit that gap? I have no idea. If I'm long beans or if I'm short beans, I want to have a plan for it. Switching over to the wheat. So Argentina's crop's bigger. Every time you turn around, somebody's crop's bigger, and doesn't matter if it's here, if it's in Australia, it's in Russia, it's in Ukraine. Uh, Wheat has had a great growing season. I mean, Stats Canada, they grew a lot more canola and a lot more beans than they had thought. All that comes out in the wash with us being, about 20 cents away from retesting the contract lows. So, we've got March Chicago wheat at 529. The contract low is over there at 511, I believe. Let's see, 508 and a half. So yeah, there's 20 more cents to go if we go retest that contract low. If you're storing wheat, what do? Well, you keep the best floor under yourself that you can and hope that you don't need it. What I don't want to do is sit here and be like a deer in the headlight. And 2 or 3 months from now, we're trading, we're at 529 now. What if we're at 429 2 or 3 months ago? 2 or 3 months from now, we're like, oh, I could have protected $5 on the board for X. So that's what a hedge is. It's a temporary sale. It's a substitute sale. It stops the bleeding on the paper. Kansas City March down 4 1/4 cent, finished down at five. The low was 517 3/4, settled at 518. The same idea there. The contract low for that contract was back at just under $5. We traded 498 3/4. So again, there's 20 cents worth of risk there. Just defend what you can. I'll wrap it up with that. We got to finish up with the lean hogs. Lean hogs, actually, they were the only thing that was green in the protein complex. Fed lean hogs managed to finish today up 35 cents at 84.50. That's been a tremendous recovery as well, and it's given hog producers a great opportunity. We bounced to a 6-week high on this high today. If you take the sell-off that we had, which started at 92 and change and ended down at 77, we have clawed back half. And if you read my letter, you'll know. You want to use those halfway backs and those 62% pullbacks to your advantage. So yeah, it's an opportunity for you, especially if you were kicking holes in the wall and furious when we were down at 77 cents to be back up here at 85 cents. You need to take advantage of it. In the fat cattle and feeder cattle, fat cattle finished down $1.40. The interesting thing was, we were about to go challenge the gap. There's a gap on the chart. All you hear about guys talking about it. Are we going to get in that gap? The February fat cattle gap comes in at around 233.40. We did not take out Thursday's high today. That was the first sign of trouble. And actually, we had a gap yesterday, right? We gapped open higher yesterday. We almost filled that gap here today in Feb fats. If we trade 228.70, we fill the gap on the chart. Today's low was 229. So we got to within 30 or 40 cents of filling that gap. Don't miss the forest for the trees. Okay. We've had a tremendous recovery. 11, 12 days ago, we were down at 204 and change. So to go from 204 to yesterday's high, which was 231, almost 232, to finish close to 230, that is revenue worth defending, guys. That's all I can tell you in the fat cattle. In the feeder cattle, it's even more impressive. We've rallied back about $45. We had a low in March feeder cattle on the break at 293.30. Today's high, 339. So here's the weird thing today. We made a new high for the move. We got into the gap, the gap which goes from 337.5 to 345 and change, right? We got into that gap, but we couldn't fill it. And then when that couldn't happen, a lot of people bailed. It was Friday. They headed for the exits. Now it's like, okay, what's the next level on the charts to look at? That 333.20 level, that is the bottom of the gap from yesterday. So we're kind of hanging fire. Again, don't miss the forest for the trees. We've had a tremendous rally, 40 plus bucks. It's about 22 grand that you've picked up here in 8 or 9 days. The same idea goes. If you were furious when we were down at 293 because you hadn't hedged anything, yeah, okay, we haven't gotten it all back, but we've gotten darn near 50% of it back. So take advantage of that, defend what you can. Because what's the risk in cattle? Risk in cattle is if we open up the border, all that cattle that's been not coming up from Mexico, do you think that's going to be bullish? Do you think the headline is going to be, buy cattle? There's more supply coming in? No, I don't think it is. So hedge what you can. And so thank you guys for listening. Um, there's some other stuff out there too I was looking at. One good part of this, you had crude oil. I let off with crude oil being lower on the week. It's pushed diesel fuel. Diesel fuel is down 17 cents on the week. It's really given everybody a really good opportunity here around this 220 level, 219 level. Why do I say that? Well, just a while ago, we were at 270. So, the last time I checked, 220 was better than 270, especially if you have to fill your tanks. There's some technical stuff down here that guys are going to be looking at. Can we go lower than 220? Yeah, anything's possible. Back in May, we were down at 193. But we went from 193 to, when we had the issue with Iran, right? We spiked up to 274. So this is a dip that you might want to consider using if you need to fill your tanks. A lot of guys probably have already done it, but if you need to buy some, I'm always a big fan of buying stuff when it's 50 cents cheaper than it was 2 weeks ago. So there's a gift for you. Guys are always like negative, negative, negative. I get it. The price of our outputs is not what we need, and the price of our inputs is higher than it should be. But when an input like diesel drops, I at least try to take care of it. Try to take advantage of it if you can. You might not be able to, but it's something to look at. Um, Interesting stuff going on with the U.S. dollar and silver. Somebody yesterday in silver paid the all-time high near to $64. Today it's trading 60. If you look at silver, since October we had a 15% sell-off and then a rally, and then in November we had about a 12% sell-off and then a rally. So how big is this correction going to be? I don't know. Longer term, someone wants to own silver, which is good. I can go back to 2012 though, and just go back there and look and see what's the risk. The risk is that something changes geopolitically, and this market does what it did. In 2011, 2012, yeah, we were trading $50, and then and the bottom of the COVID, we were trading 11. Somebody rode that down. So I understand you want to be bullish. It's fun to be bullish. It's fun to be long when the market's rallying, but just please have a plan, because you don't want to be sitting there if and having to explain, gee, we paid $62 for it, and now it's trading X, and how long is it going to take us to get back to $62? All that type of stuff there. The same can be said for gold. Gold couldn't get the 4,400 print; it got the 43.98. Then people forget we had a $500 sell-off, right? They never talk about that on the commercials on TV when they're selling gold. Somebody bought the high and then wrote it down and had to sit there at the dinner table and explain to their spouse that don't worry, it'll come back. Good news is it has come back. We got to within about 30 or $40 of re-challenging that all-time high, but it started to slide there as well too. So maybe this stuff's taking a breather as we head into the end of the year. Again, 99% of what I focus on is corn, wheat, and beans, but the outside markets do affect it. Why? Because if the outside markets get giddy and everybody decides, gee, we really want to own commodities, that's a good thing. We saw that happen in 2020 during the COVID explosion, right? Everybody just wanted to buy stuff. Didn't matter if it was lumber or fishing boats or RVs, whatever. People wanted to own it. So that's why watching stuff like this matters. All in all, at the end of the day, we'll see what happens. I'm kind of disappointed in the action in beans with everybody else. It's no fun to go from 18-month highs and then just watch the market give back 90 plus cents. I get it. It's no fun. That's why we try and manage risk. Okay, this is Chris Robinson, 312-638-8868. I will be sending out the weekly wrap, and I'm also going to do my private client webinar. I tape it. I send it to you. You can follow along with it. You can see what I'm looking at. There's a lot to talk about in cattle, which I'm going to cover on that webinar. I'm also going to cover where we might find a floor possibly here in soybeans. And also the third thing, how do you hedge when we know we've got a USDA report on January 12th? How do you hedge your risk? All right, guys, thanks for your time. Have a great weekend. Take care.